What we're seeing right now is beginning of the end of US exceptionalism. And what I mean by that is the US has attracted an awful lot of money, sucked money from around the world, and tech giants have become so huge. There is this trend that is happening of investors thinking, look, I don't want to put all my money there. I think this era of being in the really tense geopolitical world is that we are going to see more money as well. We've already seen it going into defense companies, increasing security.
Some people might be wondering, how did we get to here? Why are we in a situation where this is happening across the world?
Well, it's partly because of the innovations that were unleashed by those tech giants. You can also trace this back to what happened with the great financial crisis. And that was so painful for people. Their wages stagnated, their living standards went nowhere. I think we could be at the late stages of an AI bubble, because even though obviously AI is going to transform our societies, the journey is going to be a pretty bumpy one going forward.
What regions do you think are best positioned to dominate wealth creation in the next decade? Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building. We have Susannah, who is a leading financial commentator and global markets expert. Formerly head of money and markets at Hargreaves Lansdown, she's known for translating complex economic and geopolitical trends into clear, actionable insights. Susannah, how are you doing today?
I'm very well. Yeah, it's fantastic being here. What a brilliant studio. I've actually come from the Bloomberg studios in central London for a big women power and money event, which was super exciting. So it's really great to continue the theme into this evening.
Yeah, and I'm looking forward to this conversation because when we were talking offline, we were talking about so many things are happening in the world right now. But I think that some of these topics are so complex and they don't always like break it down for, the everyday person. So I think the work that you do is so incredible because you do really try to help, relate what's happening to the world and how that applies to our wallet. So it's going to be a very valuable conversation. I want to start this podcast a little bit different. What values or lessons from your upbringing have had the biggest influence on who you are today?
Well, my dad was an accountant and my mum's a teacher. And that obviously did have a little bit of an impact because I've got that kind of, teachery element to what I do. But do you know what? When I was younger, my dad never thought that I would go into finance because I was more into amateur dramatics and drama and literature and that kind of thing. But over time, I've become so much more like my dad. It's been quite incredible. It's been an incredible journey because what I did is I went into journalism because I like the fusion of politics and economics with journalism. And then from journalism, I kind of segued into consumer finance and then into actual, stock market finance. I'll tell you more about it a bit later. But that's when I really uncovered my love of turning figures into imagery and words effectively. Yeah. My job is kind of to turn numbers into words. And so I've actually got that from both my parents, I would say. Okay. But also, why was I interested in money and saving and investing? It's the kind of saving, the money saving, I think that was my first love. I've always been into getting a bargain. I love going to jumble sales. I love making my money stretch further. And, I grew up when interest rates were really high. We didn't have a lot of money. And we talk about interest rates being high now. They were sky high in the mid-80s. And so we didn't have a lot of money as a family. And we still had loads of fun anyway. So it's actually trying to work out how you can really enjoy life on a budget. And that's kind of what propelled me into saving. And then later on, working out if you've saved, how can you invest and then grow your money? Yeah.
What was the world like at that time with higher interest rates? Because as you mentioned now, people say, oh yeah, interest rates are high, but you're right, it was much higher.
Yeah, and it was really tough if you had a mortgage and suddenly, of course, we've experienced this a little bit, haven't we, with interest rates ramping up because of all the impact of coming out of the pandemic and then the war in Ukraine, making commodity prices, food prices, energy prices shoot really high. We've experienced a bit of that. But let's remember back in the 1980s, interest rates were much higher. And so it was really tough if you were trying to pay a mortgage. And so we were pretty frugal, I would say, growing up. I didn't feel it necessarily at the time because so many more people were, but you'd never go out for a meal. I mean, there were no Nando's. There were no once I think we used to go out for Wimpy for our birthdays once a year. But this kind of expectation that you go out and have a meal as a family. It was a real treat. It was packed lunches, sandwiches, all the time.
Wow. Now that you say that, it reminds me to the time when I was younger. For birthdays, it would be like Pizza Hut or McDonald's. That used to be the birthday. And now I don't think that anybody does that. I think they would kind of look down on that a little bit.
Oh, no, my kids still love that.
Do they?
Oh, yeah.
For birthdays?
Yeah, but
yeah.
Cool. We kind of want a little activity and then go to McDonald's.
Back. Yeah, you got to bring it back. Yeah, it's fun.
The older ones, not so much. More wagamama.
More wagamamas, yeah. So, in your journey, what would you say was the biggest financial wake-up call that made you rethink how you handle money?
I would say there's two occasions, actually, when we're talking about my parents, really trying to make sure that we have fun. Once we wanted to go to France on holiday, but we didn't have enough money to take the car. And it was quite hard for me to get my head around that. I was about 9 or 10. I was like, well, why can't we just take the car? Because it was so expensive to put the car on the ferry to get there. So they devised a plan that we would all take a rucksack, get the bus down to Portsmouth, go over as foot passengers, and then go on buses in France to get to the campsite where we would pitch our tents. Wow. And so that realization that you could still do things which were fun, it was one of the best holidays that we had during my childhood, that you could still have, a great time and not spend a huge amount of money. That was really good experience for me. Yeah. That was that for sure. And I still think that camping, I actually think it's, cruel to your children if you don't take them camping.
Really?
Because I think you've got to have that baseline of understanding that, villa holidays shouldn't be usual. You should be able to not rough it, but enjoy the basics, So that was probably my first time that I really thought, oh yeah, it's very expensive to take the car over, and worked out all the pricing of the holiday. And then I also, on the other side of the scale, my sister lived in New York, 1999, and I went over with my boyfriend at the time, and we went to the Rockefeller Center for drinks. And when the bill came, it was £180.
Oh my God.
And I was a lowly, not very well paid journalist at the time. And that was just so much money. And we were just kind of, okay, we've just got to pay this. And, the cocktails were fine, but they weren't that great. And then I went down the lift at the Rockefeller Center, and there was a homeless man. And a lot of people who were coming down that lift just walked past him. And I knew that they'd just spent £180 on their cocktails because we had, and they didn't stop. And that again, that was like, God. So we did give him some money, even though I already didn't have any because I spent all on those drinks. But because it was just really shocking. And that realization that you can really waste your money, and you've got to be really careful about where you go. Because, and also realizing that, society is so unequal.
Yeah. The first one is like leaning into being resourceful. And I think like sometimes people forget how to be resourceful. I had a conversation with a financial advisor a few weeks ago, and it was talking about like some people have forgotten to have fun without doing just pure luxuries. Like you can't have fun without that, which is actually not true, right? There's so many ways that you can have joys in life where you can spend a minimal amount, and it doesn't have to. Of course, if you can spend it, of course, but just because you don't have that much doesn't mean that it can't be fun still, right? And then the difference between poverty and that gaps in wealth. Yeah, I think sometimes as well that can happen, and people also don't realize what they've got as well as much. So yeah, I think it's very important.
They don't, and remember in the pandemic when everything shut down, all the kind of favorite restaurants and bars and activity centers, and everybody was reduced to making their own fun, like
Yeah.
going to the wood on your walk out, and suddenly that rediscovery that you actually, there is so much in life that is free and you've just got to grasp it. There's kind of, we've forgotten that a little bit again.
Yeah.
And I think it is really important to keep that in mind.
Yeah, I think people have got to definitely just reconnect and just do the basic things from time to time. And it's one of the things I like to do. Look, on weekends, sometimes I just like to relax and do nothing.
I love
work
doing
hard.
that.
Yeah, you know.
I love doing that, but it's very rare.
Yeah.
I'm not, as my husband would tell you, you're really not very good at doing nothing. I always like to be doing something. I actually find that slightly relaxing. Just maybe not 3 things at once, just
3
one.
rings at once, yeah. And then people, you know, sometimes for me, it's like I've grown to teach myself to like slow down a little bit and just enjoy the present parts of life, you know, because I'm very future thinking and I'm very, okay, what's next? But sometimes I just say to myself, you know what, let me just take a bit of a breather, enjoy what you've got, enjoy what you've done. And, you know.
Yeah, you've got to do that.
Yeah.
Absolutely.
So important. So looking back, what decisions most influenced your journey from journalism into financial markets and ultimately becoming the head of money and markets?
So I joined BBC Three as one of the first presenters of the 60 Seconds Update and also the 7 o'clock news show. And then there was a job that came up for BBC Breakfast as a consumer reporter. And at the time I was like, I could do that. I like shopping. And actually I kind of blagged my way, not blagged, you know, I went for the interview and I managed to get this job as the consumer reporter. So I would report on all the high street trends, you know, what was happening with our personal finances. And then I started standing in for Declan Curry, who was at the London Stock Exchange, who was the presenter who would focus on financial markets. And then that was a kind of real discovery about the world of financial markets. And so I'd have to get there very early in the morning, 4:30 in the morning, and plan the show and interview lots of CEOs from various different companies. And that was fantastic, really getting to understand how equity markets worked, but also commodity markets, what the price of oil meant, how did that signify trends in the global economy. And so from there, I spent quite a long time at BBC Breakfast, but then they moved up to Salford. And so then I got a job on the BBC News Channel as one of the BBC anchors for business. And then there were changes at the News Channel. And then I got a job for the BBC World Service, which was actually quite an ambition of mine to be, you know, on the BBC World Service because it was so iconic. I love to follow Kate Adie and really iconic journalists when I was a student. So getting a job on the World Service was great. And I presented this show called Business Matters. Business Matters went out. So talking about time zones, I started off at the BBC, you know, getting up at 4 a.m.
Wow.
And then this show didn't go out until 1 a.m. So it went out between 1 a.m. and 2 a.m. in the morning. But the great thing with that time is that you could report on what happened on Wall Street at the close and also what was happening in Asia as the markets opened there.
Yeah.
And so it was, really great conversation and really great perspectives from Wall Street, Hong Kong, Mumbai, and my job was to bring them all together and explain what was happening in the global economy. Yeah. So I did that for 3 years. And one of the jobs that one of the interviewees that I used to speak to a lot was, say, financial market analyst. And we had a variety of them who are our presenter friends on the show. And they would just give us the update on the financial markets. What was happening? What did it mean? And I decided that if I was ever going to leave the BBC, that was the job that I wanted to do because I've been so immersed in markets. Yeah. The problem is that I had 3 children. They were all quite young. My home base was Bristol, and there weren't many city jobs in Bristol where you could be a financial markets commentator. And then one popped up, which was at Hargreaves Lansdown, based in Bristol. Okay. And so it popped up, and it was the day after my daughter's 5th birthday, and I thought, I've just got to go for that job. And I went for it and I got it. Okay. So that to me was the sign that I was ready to leave the BBC and forge a new career in financial services. Wow.
I want to ask you a few things because there's a show that I can't remember. It's on Apple TV and it's about working in the media. I can't remember what the show is. You might know it.
Yeah, it's with Jennifer Aniston.
Yes.
Yeah, Apple TV. Not the newsroom.
It's something like
the
that.
breakfast. The
Morning show.
The morning show. How
That's
can I
it.
have forgotten that?
The morning show.
So,
Yeah.
do you wanna- yeah, it's the morning show.
Yeah.
Yeah, it's the morning show.
Yeah. So one of the things that like piqued my interest was that she woke up so early, and then you saying that you woke up at 3 a.m. You also worked at 1 a.m. How did you keep that dedication? Because I think it's so important. It's so amazing.
I had wanted to do that job for so long. And there's something about live television or live radio that you have to be there. You know, the show is going to go on. And I still have a recurrent bit of a nightmare that I don't wake up in time.
Really?
Yeah, sometimes still.
Okay.
And that I'm running up to the studio and I don't quite make it. Yeah. There's a bit of a recurrent nightmare of mine.
Okay.
Even though I don't work for the BBC anymore.
Wow.
But I'm often on the BBC, but I don't actually have to anchor the show. And yeah, I think I've just been conditioned over time that the alarm goes, I'm up. I just get straight up.
Okay.
I don't mess around. I don't put it on sit. I'm just up.
Okay.
And that's it.
So it's just that you just have that discipline to just get up as soon as the alarm.
Have to have a cup of tea.
Yeah. Have to have a cup of tea.
In fact, I was staying at a flat in London recently, and the kettle broke, and it was a disaster for me. So I had to go out late at night to John Lewis and go and buy a kettle, because there's absolutely no way I could get up this morning. There was absolutely no way I could get up in the morning and go on Times Radio without my cup of tea. Because I'm still on early mornings every Wednesday on Times Radio.
Yeah. So for you've got that discipline. And where would you say that discipline comes from? Because, some people that watch and listening to this would like to have that discipline in their lives to do the things that they set out to do. I mean, you were doing this for 3 years at 1 a.m. It takes a lot of dedication.
Yeah. But also because you're working with a team and they're all relying on you.
Okay.
So you have that responsibility, you need to be there. I mean, obviously you've got to really have the passion. You have to really like what you're doing, I think. And if you don't feel that you have the passion and would be able to get up at that time in the morning to do it, then maybe that's not the right job for you. And maybe you should find a job where you really do want to get up really early in the morning. Yeah. And I think that's the crux of it. I think most people can do it if they're passionate enough. Okay. And if it really fires their mind.
Yeah. Okay. Yeah, no, I appreciate that, because I think it's really important and to call out that dedication, because that is amazing. I don't think I've had anybody say that they worked at 1 a.m. 3 years. I don't think I had anybody.
The actual worst shift I ever did.
Yeah.
Was for the Newsday programme, which was on the BBC World Service. That was before I got my job at Business Matters as the anchor. You went in at 9 p.m, you worked through the night, you finished at 9 a.m. And you were on air between 6 a.m. and 9 a.m. And that was hard. Yeah, that was the hardest. Working night shifts. Yeah. It's really hard. Yeah. And I salute anybody who does that day in, day out, or night in, night out. It's really hard. Gosh,
I mean, if anybody's watching this on a night or listening to this on a night shift, salute to you. XTB is currently giving new clients a free share in Rolls-Royce when you open an account, verify it, and make your first deposit. And within a few days, that share is yours. I use XTB myself because it makes investing simple and affordable. You pay 0% commission when investing in stocks and ETFs, and you can earn up to 4.25% interest on any cash sitting in your account. You also get access to 10,000 stocks, ETFs, can start with as little as £10 and enjoy quick, secure and free deposits and withdrawals. It's one of the most straightforward platforms I've used, whether you're just starting or scaling your investment portfolio. So, if you'd like to kick off your investing journey with a free Rolls-Royce share, check out the link below or use code SAVVY and sign up today before the offer closes on the 30th of November 2025. Please note, the free stock promotion applies to the United Kingdom only. Your capital is at risk. The value of the stock may fluctuate. Limited availability. T&Cs apply. So, wanted to talk about the future of money and markets. What do you see as the biggest shift in global markets over the next 5 to 10 years?
So what we're seeing right now, and obviously it's been playing out in the headlines, is at the beginning of the end of US exceptionalism. And what I mean by that is the US has attracted an awful lot of money, sucked money from around the world, and tech giants have become so huge, partly because of the amazing technology that they have, but also because the US has been seen as a very stable place to do business. And the Trump administration has kind of upended all of this. Obviously, we know that trade rules are being rewritten. We had that huge turmoil on financial markets in April. There has been this recovery. But there have been other trends in terms of what President Trump has done in terms of the rule of law in the United States, chipping away of that, also attacks on the independence of the Federal Reserve, the US central bank. And all of this is kind of having an effect that, it hasn't completely chipped away at the US dominance at all. You've got these still sky-high valuations, and a lot of money is still being attracted into US capital markets. But there is this trend that is happening of investors thinking, look, I don't want to put all my money there. I'm going to have to rebalance my portfolio and look at other regions around the world, which could offer a bit more security going forward. So there's that trend. And then also, of course, we have really fractious geopolitics. Got the ongoing war in Ukraine. We've got still chaos in the Middle East, really distressing scenes. Some uncertainty as well in the Asia Pacific. And I think this era of being in the really tense geopolitical world is that we are going to see more money as well. We've already seen it going into defense companies, increasing security. And at the same time, bad actors are using, cyber attacks. Could be actually state-sponsored, and we've seen some of that. But also, just hackers who want to hold companies to ransom to make money. So that's another real kind of theme. So I think what we're going to be seeing over the next couple of years is lots of investors thinking, this is all pretty uncertain. I really want to find investments that are going to offer resilience. We're not going to have this really high growth that we've seen in recent years. So it's kind of adjusting where you put your money to make sure you're more resilient, and that you might not make a fast buck, but you won't see your wealth erode.
Yeah. Some people might be wondering, how did we get to here? Because I always wonder, we're in 2025, we're such a modern society. We've got technology, AI is coming up. Why are we in a situation where this is happening across the world?
Well, it's partly because of the innovations that were unleashed by those tech giants who are sitting on those huge valuations right now. It's to do with social media, a lot of it. And unrestrained social media. I mean, we saw this with the Brexit effect. So much rumour, and that was channeled into the Leave campaign, all this rumour and speculation about how there would be waves of immigration. And that was, it just kind of exploded on the side of the Leave campaign and took people by surprise. And you're still seeing the effects of that. But then you can also trace this back to what happened with the great financial crisis, because obviously there you had a number of banks that could be that were on the verge of going bust. Yeah. The UK government stepped in, bailed them out, had a slightly different policy than they had in the United States, where Lehman Brothers was allowed to collapse effectively. But certainly it was so systemic here in the UK that because the government bailed them out, it meant that came at a hefty cost. Yeah. And so the government at the time said, look, we need now to really batten down the hatches and unleash this era of austerity. And that was so painful for people. Their wages stagnated, their living standards went nowhere, in fact, decreased. It's a really tough time. And so by the time you got to the Brexit vote, people were unhappy with their lot, as well as being fed these images of waves of immigration on social media. And I think it was a protest vote against the government. So I think that's, again, what you've seen play out in the United States as well, in that because you've had inflation taking off, living standards have fallen back. Yeah. Millions of Americans feel disgruntled with their lot. They think, look, my life is going backwards. It's not improving. Yeah. Everything's getting so expensive. Something needs to change. And so then you have these protest votes which erupt in Brexit or a vote for the Trump administration. That's my view about how we've got here. And then, of course, bubbling along in the background are, geopolitical elements to this. Putin being angered by what he sees as the enlargement of NATO, and then unleashing the war in Ukraine, which then led to this spike in commodity costs, making inflation even worse.
Wow.
So there's this whole combination of factors swirling, but it's then amplified by social media.
Yeah, and it's not making our lives easier, right? Because obviously, wars are distressing, and then not only that, then we're getting also hit in the pocket as well, and then our standards of living isn't as great as well. So you mentioned a few different regions. What regions would you say do you think are best positioned to dominate wealth creation in the next decade?
Well, I think the US will still continue to dominate in many respects, but I don't think quite so much as it has done. I think we could be at the late stages of an AI bubble, because even though obviously AI is going to transform our societies, the journey is going to be a pretty bumpy one going forward. There's been such huge sums ploughed in. And some of the really big tech giants, I'm talking Meta and Amazon and Microsoft and Alphabet, the owner of Google, look, they've got really deep pockets, and so they can afford to really splash the cash. But then, of course, you've had this effect on lots of other companies as well that, are branded AI. And so you've got these really big surges in valuations, and I do expect that we will see correction in that coming up. Yeah, so I think that will put a lot more volatility into the market.
Okay.
However, they are so huge, the likes of Nvidia, and so well positioned that I still think, there will be big survivors of this AI correction.
Okay.
I don't necessarily want to call it, a huge bubble burst. It's uncertain exactly how it's going to play out. But I think there will be some kind of correction because, you've got Nvidia funding OpenAI so that OpenAI will buy Nvidia's chips in this kind of weird reliance, and that's similar to what happened in the .com era. So we're almost getting to that stage. So I think there will be some kind of changes. So there may be, less incentive to invest in tech and more incentive to invest in other areas like infrastructure, like battery power, like reinforcing grids for the green energy, for example, and also a move towards different geographical regions. Already you're seeing this. Lots of institutional investors, like the big pension funds, for example, they're moving more towards investing in Europe. Also, Japan looks more attractive. And even China, given that valuations in China have really been pushed lower. And even though there is still uncertainty about the Chinese economy, there seems to be a lot more appetite growing about investing in different areas of the world.
Yeah. When we spoke, you mentioned cybersecurity, and something happened a few days ago. I think it was Jaguar Land Rover, right?
Yes.
I think they got hacked as well. Do you see that as a big long-term investment opportunity, and how should people kind of look at it as well?
Well, I do. And you've got this year alone, you've got Jaguar Land Rover. It had to shut down its factories because of the hack attack, and only just getting them back online. And you had Marks and Spencer had to shut down all of its online operations for around 3 months. Click and collect completely suspended.
Wow.
And then you had the Co-op that's been hit by a hack attack. So many different companies. And when you look at the spend on cyber protection against these attacks is going up hugely, but it's in the billions. Yet we're forecast to have the impact of cyber attacks could be in the trillions. So you can see there's a massive gap between what they're spending and what needs to, and the threat.
Yeah.
So there's this gap, and it will be filled with investment. And a lot of cybersecurity firms are relatively new, or the innovations that they're using are relatively new because they're trying to harness AI to try and stop the hackers. So it's evolving all the time. So you can invest in a number of ways. I mean, there are funds that are focused on cybersecurity innovation, specific exchange traded funds that focus on that. Yeah. And so in those funds, you'll likely to have kind of more early stage companies, a bit of a mixture, a bit of a mixed bag. And of course, if it's a fund, you're spreading your risk across a number of different companies.
Yeah.
You could also look at, say, for example, Amazon or Microsoft, because they're also devising lots of tools using AI agents to try and counter the threat of attacks on various different platforms.
Yeah.
So there's a variety of ways that you could get involved in investing.
Yeah. And I think cybersecurity is an important area because we're always going to need it as the world evolves more into this AI world that people are talking about. You're going to need some form. And we spend so much time on the internet. We spend so much time on our devices, and there's so many ways that people are getting hacked or scammed. Like I probably get like a scam call a day. I did an episode actually on scams about a month ago or so, and it really blew my mind because of the number of ways that people were scamming using deep fakes and all of that. And the deep fakes are getting more sophisticated.
They really are.
Yeah.
I created my own avatar.
Really?
Yeah.
Okay.
So I spent 4 hours in a TV studio, and it's because I hosted and chaired an event in Riyadh in Saudi Arabia about AI, and I met the founder of Yepic AI, which is this company that creates AI avatars, which are so lifelike. And I was like, I really want to try and create mine. And so I took it to a conference, and I could actually ask Agent Suza questions, and she'd reply. And she'd even reply in Polish when a Polish speaker came up. And this woman spoke to me, I would reply in Polish. There was a bit of like the Wizard of Oz. Yeah. The founder had to go behind the scenes and push a few buttons.
So what was it on screen? You would be
it was
on
on screen.
Oh my
so
God.
I could ask Agent Suza questions, and she would respond to me. She was a bit posher. She talked like that. She talked like that and was a little bit posher than I am.
Oh my God.
But it was
That's
incredible, and it's terrifying.
Incredible and terrifying.
Yeah, because it shows you just how easy it is.
Yeah.
I mean, obviously, she was particularly good because we'd spent a long time creating her.
Yeah.
But even so, you would have thought that it was me, and I'd just done a pre-record.
Yeah. What do you have to do to create that though?
So I was sitting in the same position, and I would have to talk for about 3 minutes and then do lots of nods. So it's also how you are when you're not talking. So when you're listening, that can be a real giveaway. So if they're not very sophisticated, you might see them juddering. But if you've done a lot of filming and you've been involved in it, the model can take all the images of you listening as well.
Okay.
And it's your movements. And say, for example, I would unfold a paper and put it up to myself. All of those types of movements. A bit like if you've ever been to see ABBA Voyage, it's how they created that.
Right.
But that was obviously very intense.
Yeah.
But all the different movements and just the way that you move your arm and making sure that your movements are really mirroring how you actually
That's quite scary, isn't it? Yeah. Because I'm thinking, right, like as a creator, if a nefarious actor got this and then just copied it, because you would have less potentially, like, creators got loads of video content, you find that creator on a podcast, then you can just create that avatar of them and then start defrauding people using that.
Yeah, I think though,
That's crazy.
I think there is such a backlash against them. I mean, you look at what's happening in Hollywood at the moment, that any sniff of an AI actor being actually employed in a film, there'd be huge strikes. And that was part of the reason why we had the writer's strike a couple of years ago, because of this real concern that that AI would take jobs. And there've been a lot of caveats put into contracts and ways of working with the studio. So I think actually you're seeing this real backlash. So my rule is that I'm only allowing Agent Suza out under my permission, and she can come to a conference with me if I'm hosting that conference and be my helper. Okay. But I won't let her go off on her own.
Yeah. Okay. This is so interesting. Like, honestly, that is beyond cybersecurity. What other long-term themes do you see as the most investable given today's geopolitical shifts?
Well, obviously the defence sector.
Yeah, you mentioned
but then again, a lot of valuations have gone up quite a lot. And defence brings ESG, environmental, social and governance considerations, obviously. But actually there are some attitude changing towards defence because, of course, there is this more general acceptance that Ukraine has to be supported against Russian aggression. And to do that, it does need to defend itself. Yeah. So I think you got a little bit of change in attitudes towards investors with regards to funding defence. But then again, it depends what type of defence. People might have more appetite to fund aircraft, for example, rather than weapon systems. So, it is quite hard to unpick, really. But certainly there have been a lot of companies have seen their valuations go up a lot. So you could say perhaps right now it's not a brilliant time to invest, and maybe invest in a fund that would invest in smaller companies that haven't quite seen the same rise in valuations. Yeah. So certainly defence, infrastructure as well. Obviously, for defence, you need the buildings, and also with the AI revolution or electrification, you need a lot of power. You need data centers. So some parts of kind of real estate as well, I think do have a lot of opportunity ahead. Yeah. So real estate and infrastructure, logistics hubs, because the e-commerce revolution is not going anywhere either. So that's going to continue. A lot of people
are not so focused on that as much, because it's interesting because Amazon is so huge, but there's so many other regions in the world that are still building in that area that are still untapped.
That's it.
Yeah, many people are not looking at. I feel like people always look at the hot areas all the time.
Yeah, that's the thing. You've got to take your own think. What's next? Where is this? Has this not happened yet? And also for real estate, it's been really tough because, of course, with high interest rates, that means it's much more expensive to borrow large amounts. So private equity, having a much tougher time for leveraging these big deals. And again, for real estate, because of the high interest rates, it's been a tougher time. But particularly in Europe, interest rates have come down more quickly than in the United States and in the UK. And so there's likely to be more opportunity in real estate in Europe first, I would say.
Yeah. What are you seeing about Europe that investors are liking more about it compared to like the US?
So valuations compared to the United States are still lower, even though they've climbed this year. Okay. So that's part of the picture. There's a big part of the picture. Also, as I said, interest rates are coming down more quickly. Yeah. That's offering greater clarity about what's ahead. And then Germany has recently announced a really big spending project in infrastructure and defence, and that's really a game changer. And so there's more appetite for Europe because of that.
Okay. I had this question, right? And I've always seen this around, and I think some of the watchers and listeners are gonna, be interested in hearing about this. Can you explain what de-dollarisation actually means and why it matters for people investing today?
So de-dollarisation, the dollar is really known as the world's reserve currency. And de-dollarisation is chipping away effectively from the status from the dollar as the world's reserve currency. And so what you've seen this year is the dollar really lose value because of all those issues about trade, uncertainty about what may lie ahead for the US economy, dents to the rule of law in the United States. All of this has had this effect on not just what could the outlook be for the US economy, but just perceptions of just how stable the US is, and then that's reflected in the price of the dollar. Okay. So de-dollarisation effectively means that other currencies could rise in prominence as reserve currencies. So what you would hold in your central bank reserves in case of any kind of crisis, or what you hold to make sure you've got enough to pay for commodities, like oil, for example, on the markets, because it's priced in dollars. And it's other currencies rising. And China certainly wants its currency, the yuan or renminbi, to start to take the place of the dollar, which is why it's been employing different policies, such as buying up gold to keep in its borders. Yeah. And also encouraging investors to invest more in China to try and make the economy more attractive, to try and build up the profile of the yuan instead of the dollar. it's going to be a long-term thing. It's not going to happen overnight, certainly. But it's part of this trend of the dollar perhaps falling back in its popularity as a reserve currency.
Okay, and why does that matter for, I guess, for investors? What's like the impact of that?
Well, it does actually, if the dollar falls in price, it does make, say, commodities that are priced in dollar more attractive, which is partly why you've seen gold rise, as well as gold is seen as a safe haven. But obviously, it's more attractive if it's priced in dollars. If the dollar declines, it's seen as a more attractive commodity. It also, though, has implications if the dollar continues to fall for inflation in the United States, and the US is the world's largest economy. And if inflation stays higher, stays stickier in the United States, then interest rates will have to stay higher. And if interest rates stay higher, that affects the value of the future earnings of tech companies. Now, tech companies' valuations are based on what they're going to make in the future. And depending where interest rates are, if the interest rates are higher, there's a higher discount on their future earnings. And so then it will affect their valuation. So if you're invested in tech, if the dollar declines, inflation increases, interest rates stay high for longer in the United States, that then can have this kind of knock-on effect on valuations in other sectors. So it's all interconnected.
Yeah, wow. There's a lot. This is the thing, and this is what makes investing sometimes so it's amazing how investing is so linked to what's happening in the real world. But what's happening in the real world, so much movement and action is happening. So this is why I wanted to have this conversation, because so many different things are happening. Like you mentioned, the tariffs in the US, China wanting to, let me say, not establish dominance, but trying to, get up there a little bit as well. I've got another question for you. The US being the world reserve currency, why does the US want that? Is another question. Why would they want to keep their position at number one?
Well, it's the world's largest economy, and so it's the recognition that it's that kind of prestige, that recognition. If you have the problem is, though, actually, when you say, why does the US want it? Well, actually, President Trump doesn't necessarily want it. In fact, he would like to see, he doesn't mind so much that the dollar is devaluing, because that actually helps US manufacturers who export to the rest of the world.
Interesting.
Because it makes the cost of their goods cheaper, so can support manufacture in the United States. So, that again is a real change. But I mean, it's a prestige. It's certainly the prestige of having the dominance of the dollar.
Okay, I didn't know that about Trump. He is shaking things off a little bit, to be fair. What practical steps can investors take to build a resilient portfolio, and why is a long-term horizon so critical for building wealth? So
when you talked about just now, but there's all these things, and it can be really kind of confusing. This is exactly why you need to have a diversified portfolio, because if interest rates are higher in the United States, well, that they could be lower in Europe, so there's more opportunity than in Europe. And so that's why you need to make sure that your portfolio is diversified, not just through different sectors, so industrial sectors like tech and pharma and energy, but also in different geographical regions. Because at any one time, there are times, for example, the pandemic, the financial crisis, when there's this huge drop in confidence across the world. It doesn't happen that often, but it does happen. We saw it in April, that huge volatility. And it does happen when sectors and geographies almost, all fall at once. There's a bit of chaos going on. But most of the time, what you'll find is that some geographical sectors aren't doing so well, but others are doing better. And so what you need to make sure is that you've got investments in all sectors, so that across the board you're going to be a bit more resilient. And that's why it's so important. But also, it's not just say making sure that you've got equities, you're invested in companies and share in slices of companies, but also you might want to invest in bonds, so either government bonds or corporate bonds. So effectively, you're buying a slice of government debt or corporate debt. And that is seen as also as adding resilience because it's called fixed income. You know that you're going to invest a certain amount over a period of time and you'll get a certain interest payment. Yeah. Now, the value of that debt that you have may rise and fall, and if you needed to sell it quickly, you could lose out. But if you hold it to term, you'll get back what you invested, plus, of course, all the interest as well. Yeah. So that's why bonds can also offer real resilience to a portfolio as well.
Okay, amazing. No, thank you for sharing that. And I think it's like very important for people to understand that, you know, having a diversified portfolio is important. One way that people often, and I've had this debate on the channel a lot, and it would be great to hear your views on it as well. So many people like S&P 500 global index fund. I actually had a debate on that, S&P 500 versus global index funds. What are your general thoughts on that as vehicles for people to use, especially as they're beginning their investing journey?
Yeah, so they're cheaper often if you invest in an index fund. It tracks, say, the FTSE 100, the S&P 500. But remember, particularly in the United States, that the tech sector has a huge weighting on that index. So you're not necessarily diversified. If you just invest in that, you may think you are because you say you're diversified, you know, getting a slice of, you know, the 500 listed companies, but actually because tech is valued so high, you're really very weighted towards tech. Now, if you then have a number of different index funds and different geographies, that offers more diversification. Right. The problem is as well, if you just say, right, I'm just going to invest in a global fund, you also have to look at that global fund because of the huge weight of US indices and then on the US indices, US tech giants. Even if you're investing in a global fund, you're still going to be overweight mainly in US tech.
Okay.
So you have to look, when you're investing in a fund, look at what the component is. And then if you think, well, it's really overweight US, then buy some other funds which don't have US tech in.
Interesting. Okay. I understand what you're saying. It's, because of AI and the way valuations are, and you're right, in the I don't know I haven't checked it recently, so I don't know what the weighting is for global.
Well, for example, the MSCI, it's about 72% US.
Okay.
One of the global funds. Yeah. So, you know, you can see there that's
quite weighted to the US.
That's very weighted. Yeah. So you've then got to make sure that you've got some, elsewhere in your portfolio, you've got some, you know, other either index funds or sector-specific funds that help redress that balance a bit. Look, it's very difficult to say. It's very hard to call the top of the market.
Exactly.
Very hard.
Yeah.
And, you know, there's a likelihood that it'll keep going up and you'll think, oh, wow, I should have invested more. But it's always the time in the market, not timing the market. That's that old saying. And if you're well diversified and you don't switch and ditch all the time, just maybe think about rebalancing from time to time. And it's how long you leave your investments in, because then you have this effect of compounding. Because a lot, particularly the FTSE 100, it's really good dividend payers, the companies listed on the FTSE 100. And so if you opt for an accumulation, so when you choose a fund, you can go for the same fund, but you can go for income or accumulation. If you go for income, you get the dividends into your account. If you go for accumulation, then those dividends are reinvested. And of course, over time, you'll then get interest on the interest, on the interest, on the interest, on the interest, on the interest. And if you leave it in for long enough, that effect really snowballs and you get the real impact of compounding. So that's why you got to have these long-term horizons, because that's when you can really benefit from it.
What mistakes do you see first-time investors make when starting their journey?
Well, just thinking, oh, that's the hot stock. I'm going to go for that because that's what everyone's talking about at the moment. And just in there, they start off on that journey. We had this in the pandemic. Those stocks which are really hyped on social media. I mean, the GameStop frenzy was crazy. It was
yes,
crazy.
I remember that.
I ended up on a documentary with the real Wolf of Wall Street.
Wow.
Yeah, Jordan Belfort, a Discovery documentary all about what happened with GameStop, because I was working at the time and this share was just like like a rocket just because of what Roaring Kitty was saying in a Reddit sub forum. It was just crazy. And people tend to jump in the hot stocks and then they can crash and burn and then they get their fingers burnt and they think, oh, it's not for me. So don't believe the hype. Look at the companies. Don't believe the hype. Look at the companies and look into their real record. You can find lots of analysis of all the listed companies, or lots of the big listed companies anyway, online. Really great analysis from FCA registered analysts on all the major platforms, and just do a bit of homework and think, am I just buying into the hype?
Yeah.
And that is what tends to happen. And so people just buy a few shares and they don't really think, I've got to diversify my portfolio. I'm going to spread it across the world. I'm going to spread my risk. I'm going to look at different assets. So in some funds, for example, you can buy equities. You've got a whole mixture of equities and bonds and gold and even some cash. So it's kind of like a ready-made resilience. So just really do your homework.
Yeah. And I think it's important to do your homework. When you invest, you are an investor, of course, I assume, of course, because you're too interested in the market. There's no way you wouldn't be invested. What things do you look for when you're looking to invest in a company, and what have you seen around you in terms of some of the criteria and things that people will not to get them to choose, but to get them to think, okay, maybe this will be a good one to add to my watch list?
So I've predominantly invested in funds, partly because in my job at Hargreaves Lansdown, I would comment on lots of different companies, and I didn't want to be seen as actually promoting a company that I was commentating on and then buying. Obviously, that would be really poor form. So I then, because I didn't comment on funds specifically or like tell people which ones to buy, and also they're already diversified. So I haven't picked what's in the fund. Does that make sense? So I've predominantly focused on funds, and a good way of doing it actually is looking at, how far valuations have come. If you and try, if they've really shot up, it's probably not a good time to buy. It's almost like counterintuitive. Look at the ones that haven't been doing so well. And so I've invested a bit more in real estate when they weren't doing so well, and now hopefully it's turning a corner, because that's when you can make the money. Or wait until there's a big dip, which is what I did in April. And so I knew that Trump's tariffs were going to hit. And so I'd reserved a bit of money, and then I bought in that volatility when all the prices fell. But you've got to really hold your nerve, because I could have been buying as they continue to fall. So you had to have that conviction. And so I was then buying companies or funds that I did think have longer term prospects, have that mindset that you will leave your money in for 5 to 10 years. So even if there's that short term volatility, you think there's longer term prospects. So that's again, if you're investing in funds, you think, well, European valuations are really low. So I invested in a couple of European focused funds because I could see that compared to valuations in the United States, they were really low. And it's keeping your ear to the ground, looking out for, the funds to watch that various different platforms talking about, because they're the professionals, the not necessarily the fund managers themselves, because they're obviously trying to sell their own funds, but the analysts who comment on different funds and the recommendations. You can get them in many different platforms in the UK and the United States. So really just read the research, and it will give you a really good idea. Yeah, and you've got obviously Google, you've got ChatGPT that can pull out a lot of research. You pretty much got all these AI tools. Yeah, but I was also back it up. Whatever AI says, go back and find the actual document. So use it as the first. It's a bit like at the BBC. You always have to have two sources. You can use AI as one source, but always go for the backup, because you can't rely on one source. And I certainly wouldn't rely on one AI source. I wouldn't. No. I mean, you have to technically always go back to, because it can get things wrong, and it can also hallucinate as well, make things up, which you have to check. Like, where did you get this? Actually fact checked it, and it does happen as well. It's a bit scary, isn't it? And this is why, there is this real concern that will go completely towards, robo analysis. I don't, we're not there yet.
Is that thinking?
Well, there is this speculation that, you could get rid of analysts and, you wouldn't need, but it's always that you need a human in remote control.
I think so, yeah. Yeah, I think so. Just to check. It's always good. I think, if anything, the way I see these things are, it makes it a bit easier, but it shouldn't stop you doing the work. So you've got to do the research yourself. You've got to, value it yourself. You got to keep up on the news yourself. You can't skip all of that work, right?
No.
Especially if you're investing
exactly.
in
You've got to look, is that company, has it got good cash flow?
Yeah.
How is it making money? Has it got visibility into the future? The problem is that there's a lot of companies, they launch on hype and promise of what their growth prospects will be.
Yeah.
Well, if you take an investor like Warren Buffett, the sage of Omaha, one of the most famous and successful investors out there, he really just focuses on good quality companies that are at a good price and really visible cash flow right into the future, and companies that you understand what they do. If you don't really understand what a company does, it's probably not worth investing in them.
Exactly. So, over 70% of people who watch these episodes are subscribed. If that's you, hit the subscribe button. It really supports the channel, it helps it grow, and most importantly, lets us keep bringing you valuable conversations like this one. Plus, you'll be the first one to know when new episodes drop. Thank you so much for your support so far, and enjoy the rest of the show. So, if someone only has a small amount to invest, where should they begin?
So, you can invest, from as little as £25 a month. That's, what is it now? Maybe 5 or 6 coffees a month. That's how you can start off your investing journey. So it's not a huge amount that you have to find. And I probably would start off by investing in a couple of index funds. So they're the kind of low cost trackers.
Yeah.
And then broaden it to a global tracker, but as I said, making sure that you're not too overweight one sector or the other. And then once you've built up, I see it's like, imagine having lots of cake in front of you. So a fund is like a gâteau, and you take a slice of that gâteau and it's got lots of layers, and all the layers are like the companies that you've invested in. So you've got, a huge slice of lots of different companies. So you, in a way, you're already spreading your risk through them.
Yeah.
And then once you've gone on your journey a bit more and you want to take a little bit more risk, then you can invest in individual shares, which almost like fairy cakes around that gâteau.
Okay.
But they're a little bit more risky because, of course, each cake is just one company. So start off with that gâteau of investments and then go to the fairy cakes.
Yeah, okay. So it's like you say, it's like having your core, because I had a few people say you've got your core and your satellite. So having your core.
Gâteau and fairy cakes.
Yeah, gâteau and fairy cakes, a new one. We like that. That's it. Look, any analogy, we like all the analogies because it's really helpful to help people visualize, okay, how do I, because essentially when you're saying the gâteau, that's the majority of your funds is in something that's a bit more steady,
or you could say,
more,
or a main course and tapas plates around the sides.
Oh, that's a good one too. Yeah, I like that.
It's always to do with food with me.
I mean, I like look, food is something that a lot of people can relate to, and I think they're going to definitely remember that. And I think it's an important thing for people to understand that, especially like when you start investing, as you mentioned before, you don't really want to be in a position where like you lose a lot of money, because then that's when you're put off it, and then you lose out on something that is such a good wealth building tool.
But you have to remember that if you're investing, you will lose money at some point. Your portfolio will go down at some point. Well, unless you're super lucky and you invest and then
like Warren Buffett.
And you're out. But no, Warren Buffett would have lost. He would have lost some money at some point. Because when there's a big crash, there's a crash, and then it bounces back up again. Sometimes it doesn't bounce back up. Sometimes it takes so in the financial crisis, it took a much longer time to get back up.
Yeah.
Obviously, the pandemic was a crash and then jumped up relatively quickly. Took a bit of a while. But then, of course, in April, we had the Liberation Day crisis, which was a couple of weeks, and then you saw a recovery. So you have to get used to the fact that sometimes your portfolio will look as though it's lost a lot of money. So in April, I remember really early one morning, and I was on the radio. One of the sound engineers said, "I'm really stressed out. My entire pension, I've lost my entire pension because of Trump. I don't know what I'm going to do." And I said, just stay calm, stay invested. Don't do anything. Hold your nerve. Do nothing. The best thing is often to do nothing. And then 2 months ago, he went, "Oh, I'm so glad I listened to you and did nothing," because he was ready to pull it out. And then he would have, not benefited from the bounce back. So So this is why, if you need your money before 5 years, don't invest it. Just don't invest it. If you know that you want to have a deposit for a house and you want to buy it in 4 years, don't invest it. Just put it in a high interest savings account. If you don't need that money for 5 years or more, 5 to 10 years, that's when you should invest it. But always make sure you've got 3 to 6 months of essential expenditure put in a instant access savings account. So don't start investing when you can't afford it, because you then, could be in that situation, really regretting what you've done, and have lost some money because you had to pull it out at the time when the market was on the downer.
Yeah, which is, I think, many people need to hear that, because at the end of the day, like you're saying, investing in something that's long term. So you should have some money on the side that's there in case of any. Obviously, they call it a rainy day fund or emergency, right? Just in case that you need it for something. It might not even be for an emergency. You just, I don't know, it was a tight month and you want to go out and have fun.
Yeah,
right?
Exactly. You're still going to have fun.
Yeah.
You have to have fun in life. What's the point of
exactly.
just putting it all away?
Exactly.
I do think, and I look back, I could have spent a bit less on frocks and a bit more on stocks.
You think so? You would have invested more. Yeah.
Yeah. But then again, I enjoyed it at the time. Yeah. And you can, over time, when you're a bit older, you can start to build it up again.
Yeah.
So you've got to enjoy yourself.
Yeah, you definitely do. Which assets do you think out of stocks, property, bonds, crypto, or gold will attract the most money over the next 5 years? And why do you think that?
Well, I think it's probably going to be bonds. The bond market is huge.
Okay.
It's much bigger than equity markets.
Is it?
Yeah.
Oh.
So,
okay.
I think it will probably, and also I think that you're going to see a bit more of a resurgence of interest in bonds, like corporate bonds, in particular, as companies seek to kind of refinance on slightly lower interest rates. So there's going to be more coming to the market, there'll be more appetite as well for bonds, because it offers that greater resilience, because you've got that kind of fixed regular income. And I think that as far as equity markets are concerned, it's going to be companies whereby you can also earn income. So big dividend players, companies offering that bit more resilience. Yeah. So I think that's probably going to be the trends. Gold, I think there's still going to be continued appetite for gold. We've seen it keep hitting record levels because of this safe haven aspect.
Yeah.
And lots of central banks around the world are buying gold in reserve. So, but I think the bond market.
The bond market? I don't know. I would have never guessed that. I didn't know it was that big. I would have thought that it was... I would have thought it would have been stocks for sure, because that's what everybody seems to talk about.
Yeah, but
that in crypto.
Bonds.
Yeah, bonds.
Crypto, crypto obviously is growing massively in popularity, particularly among younger investors
people,
and speculators. Yeah. So, and I think you are going to see, continued growth there. But in terms of institutional investors, where all the big money is, they are starting to invest in crypto. They've been starting for a while. You've got exchange traded funds and crypto funds in the United States, but they're still only putting small portions of their portfolios, very small portions of their portfolio into crypto, because there's still so much uncertainty. The rules of the game haven't yet been laid out. In certain countries, it's still frowned upon. You can't buy exchange traded crypto funds here in the UK at the moment. So, it's still growing, but more slowly, even though there's all this speculation about it.
Yeah. Can you, is it okay for you to explain what a bond is for, if this is because we've explained it before in the podcast, just in case it's the first time somebody's listening to the podcast.
Okay, so a bond essentially is debt. You're buying debt. And the person who's borrowing your money, so it could be a government or it could be a company, pays you to borrow that money. Okay. So you get a fixed payment for lending that money, so that slice of money to the government, to a government. So that's why you could, gilts are UK government debt. Treasuries is US government debt.
Okay.
And interesting, what you've seen is the yield. So what effectively you earn over the duration of that period that you lend the money has been going up because of concerns that investors are getting more wary about lending, say, the UK government and the US government money because they're concerned that they've been borrowing too much. And that's why you see the yield go up, which obviously is more attractive for those people willing to take that little bit of extra risk. But generally, the US and the UK are considered to be really good payers, but there's just that extra bit of uncertainty that's landed recently because of the borrowing commitments. In corporate markets, there's not been so much so-called issuance of corporate debt as there has been, but that's expected to turn a corner. So there'll be more corporate debt. So companies going to the capital markets and trying to raise money to expand their plant, raise money to buy new machinery or to expand their
like
factories.
Apple, for example.
So, well, actually, Apple has got such deep cash pockets, it doesn't need to.
It doesn't need to raise debt.
It doesn't need to. Whereas other companies do. So they go to the market and say, who's going to lend me the money? And then issue that debt at a certain interest rate, and there'll be purchases of that. And so you hold that, and then you get paid an income for lending that money.
Okay. Thank you. No, thank you, Susannah, for explaining that. I think it's very important for people to understand because they will hear these terms, bonds, what does that mean? And it's what's fascinating about it is like almost like the relationship reverse. Obviously, people
like
understand
mortgage,
what a mortgage is. Everybody understands what a mortgage loan is, but they don't really understand.
You're being the bank lending the mortgage. You. So you are earning the interest on what you've lent out.
Yeah, which is fascinating to think that you can do that. Yeah.
There are different grades of, particularly when it comes to debt, there's different grades of it. So certain countries have got poor credit ratings because they've defaulted in the past. So you could demand a really high rate of interest to lend to them, a bit like, subprime loans. Banks will only lend to certain customers who've defaulted in the past, sky high rates of interest. But that's your risk that you take on because there's a chance that who you're lending the money to could default on paying you that money back. So that is a risk that you take. But again, if you say invest in a bond fund, a fund that offers lots of different types of corporate bonds, then you're spreading your risk because you're lending to lots of different companies within that fund. Okay,
thank you. So you've been through the dot-com crash and the global financial crisis. What did those times teach you about investor behavior during stock market crashes?
Well, there is often there is a flight and people get very unnerved by it and panic that they're going to lose all their money. And so can have knee-jerk reactions and not wait for the recovery. And it is very hard, particularly for those people who, really need the money out and their investments have plunged. So that's why if you need the money, within a 5-year period, it's probably best to liquidize your holding and put it in cash. If you know that you need it, it's like when you approach retirement, it's better to put it into a less risky investment. But also let's look at the dot-com crash. Companies like Amazon, they lost something like, I think Amazon lost about 90% of the stock value. Really worrying. But when you look at how far it's come since then, if you'd held your nerve, you'd have earned so much money. Yeah. Because it's gone up by so much. I can't even imagine. I think it's like 100,000% or something. It's ridiculous, So, even if there is a crash, there will be survivors of it. So there again, if you have diversified across a range of tech companies, one of them is likely to survive. And if you hold your nerve and wait for 10, 20, 30 years, you really could be in in the money.
Yeah.
So it's holding your nerve is crucial.
Yeah. How do you personally
Hold my
hold your
nerve?
nose? Yeah.
Do you know how?
Yeah.
Is by not being reliant on the money that you've invested and almost try and forget about it.
Okay.
And it is hard when you see your, red right across your portfolio. It's really hard. But you've just got to keep your eye on that really long-term horizon.
Yeah.
And also, just go back and look at the charts. And if you look at the charts, they always go up and to the right. To the right and then up. Obviously a lot of volatility in between.
Yeah.
But that's the direction of travel. Now, sometimes it takes longer for that recovery. But it's usually within a 5-year time period, which is why we say 5 to 10 years investment horizon.
Yeah. What you said about, not looking at the account and just kind of, it's not even money you need. I feel like that as well with my investment account. Sometimes I'm so detached from it that I even forget sometimes that is there, like, because it's not something I need right now. I know it's for the future. And I think you're absolutely right. When it's like that and the market goes down or it goes up, for me, it's more of an interest. Oh, is there anything that's a bit cheaper that I can get? I'm not worried about, I need to really pull it out now because I don't need it right now. So it doesn't really bother me. And I think it's a good way to detach yourself from the emotions of, the stock market and be able to sleep well at night, because it can be like, I understand for some people it can be like nerve wracking, but then again, and we've had this conversation before, if it gets to a point where you're really feeling like nervous, then maybe you're not in the right investments. Maybe you need to, if you can't sleep at night, then maybe it's like, let's start getting out.
Yeah, you've got to work out what level of risk is comfortable for you.
Yeah.
And if you're really, nervous about it, and as you say, you can't sleep at night, that level of risk is not right for you. Yeah. Why put yourself through it? It's not worth it. Go for some fixed income bond fund where there's probably going to be a bit less volatility, or make sure you go for a global fund, or go for a more resilient fund, whereby you've got kind of stocks and bonds and cash and all different investments. So, or if you've got that money, you really know you need it in, 6 years and you're nervous about it, well, take it out, put it in a high interest savings account. Yeah. But if you've got that, you're young and you've got a 20-year horizon, there is a risk in keeping it in a savings account with a really low rate of interest because it will be eroded by inflation. So that is a risk in itself. So it's just trying to work out what level of risk you're comfortable with.
Yeah. So many people avoid investing because they're negative, because they've seen negative headlines about it. How can they look past the noise and start their investing journey?
I think it is looking at that risk element and thinking about how long your investment horizon is, whether you can afford to put money away for the longer term, and looking at the return that you would get on cash compared to the historic return that the stock market has offered over the longer term. And when you look at that and you look at the offering that investing has given compared to cash, I think it would reassure you, but you just have to make sure you understand that along that journey, there will be disappointments.
Yeah. And I think people need to really, investing is something that you definitely do for the long term. And if you get it right and you get it right for yourself, then you can potentially have fun for future. That's very fruitful. So I wanted to move on to crypto, right? I've never talked about this thing before, actually. Central bank digital currency. What exactly is that, and why are some governments considering it?
Well, obviously, we've had the advent of crypto. Crypto effectively, built on blockchains, this ledger type technology. A central bank digital currency is similar. Now, it would run alongside our current digital payments and cash. But the whole idea is that it would give central banks a lot more kind of visibility about the money supply. But also, it could be a way of controlling kind of monetary policy without having to solely rely on interest rates. Because if, for example, you wanted to increase the money supply and give a lift to the economy, you could release in a very measured way kind of what's called helicopter money into people's accounts via the central bank digital currency. But it does give the central bank a lot more control, whereas crypto is decentralized. That's the whole point of it. And it's out of central bank's control. This actually gives the central banks even more power over the money supply.
Okay.
And so that's one of the reasons why they've been interested in it. And it also makes it more efficient, making payments more efficient, much more efficient. But the drawback is, of course, is that, where are banks in all of this? It's almost like bypasses the banks, and that could create kind of financial instability if you're starting to bypass the banks, which are an integral part of the financial system. And also kind of privacy concerns that people wouldn't necessarily want this set record and how they spend their digital currency, because it will be recorded on the blockchain, the ledger, and people don't want the authorities to know exactly how they're spending money.
Yeah, okay. And what does like a digital pound or euro, what does that mean for like an everyday person? So are we saying that like...
Well, effectively, it wouldn't be that much different to say how you got
your money in your accounts now.
It's more how the central bank controls the flow of that money. Okay. They're calling it a Bitcoin or digital euro.
Seen that,
The thing is, nobody quite knows exactly how they would work. They've been trialled in various different countries, but you don't know what the knock-on impact will be.
Yeah.
So it's all kind of very new still.
Yeah. What other things are people worried about in regards to these digital currencies? So,
I think it's the privacy element as well. Okay. The fact that you don't know exactly... You don't necessarily want the authorities to know exactly how you're spending your money.
Yeah.
Because, of course, it will be recorded.
Yeah, yeah.
The very nature of how it would work.
Fair enough. But then again, people...
Yeah, but you could say, but if you've got nothing to hide, why do you worry about how somebody's viewing how you spend money? But even now, people get very twitchy if cash is being withdrawn in certain societies.
Yeah.
That, there is a record, it's a more complicated record because it's very spread out through different financial institutions. There's no kind of like centralized record of it, but there would be if you had a central bank digital currency and all the
fair. Okay,
and all of the payments went through that.
Okay, I get it. I understand what you're saying. So right now, of course, like if I've got like 5 bank accounts, my transactions are going through 5 bank accounts, and that's obviously 5 different sources of
absolutely
data. Yeah.
And obviously law enforcement did want to track it. They could, but it's not like it's not simple to do.
It's not simple to do that. Yeah, it'll take a bit of time. They'll have to figure it out, and that's very different to one single source of truth. It's there, I can see it, and and we can monitor you all the time. Yeah, I don't know about the whole monitoring thing. I think that people should be able to do what they need to do with their money in a private manner, right?
Yeah.
I think,
that would be more difficult if you had a central bank digital currency.
Okay. So maybe we shouldn't get that then. Maybe we don't need that. So Bitcoin versus Ethereum, which has more long-term potential in your opinion, and why?
Well, on the face of it, if you look at what they're both like, you would think Ethereum, surely, because you can do so much more with it. So I like to describe it a bit like, say, if you've got a wood, well, Bitcoin is like the biggest tree in the wood, but it's got no leaves on it, but just really deep roots. Ethereum, on the other hand, is very abundant. It's got loads of leaves. Lots of things are growing on it. It's because Ethereum, on that blockchain, you can create loads of smart contracts and apps. Bitcoin, you can't. But it's different to Ethereum is because it's got, there's a finite supply of Bitcoin. I think it's only going to be something like 21 million Bitcoin. And because of that, it's built up to be a store of value over the longer term. That's the whole concept behind it. To be a hedge against inflation, almost like rival gold as a kind of safe haven. Now, I don't think it's there. It's not there yet because it's still pretty volatile. It has been. It's slightly less volatile recently, but you can still get really big drops, much more than you would with a regular currency. Whereas Ethereum is much more of a springboard for lots of different applications and smart contracts, and so there's much more you can do with it. However, it's got like an infinite supply. So they've grown up to be two very different beasts.
Okay. No, appreciate that. And I think it's important for people to, understand at a high level, how do these two compete? And in terms of people approaching it for their portfolios, how should they, approach crypto as part of their portfolio? How should they think about it?
Well, a bit like investing in general, I would diversify. You don't actually know for sure which one is going to be the most powerful cryptocurrency in 20 years. Now, at the moment, it looks like it will be Bitcoin, but really, who knows? People put bets on all sorts of companies in the past, which seemed all powerful, and then it didn't materialize. So actually, I would still diversify across the range of cryptocurrencies that are out there. Not so much tokens. You've got, Trump's tokens that he's pumped and then dumped effectively, and that can really sting investors who get caught up in that wave of speculation. Yeah, so just before we're around the election, the Trump and the First Lady's coins shot up in value.
Oh wow!
And then they fell back down. I
thought they were just like other people creating those.
No, it's backed by Trump family.
Oh my god!
Yeah,
how did they get away with that?
Yes, question.
I guess it's unregulated, right?
This is the
argue,
problem.
Right? That's what they'll argue.
There aren't rules. The rules of the game haven't yet been laid out. It's like the crypto Wild West. Yeah. And actually, even so, Trump has said that he's been a real fan of crypto and he wants to bring crypto more into the mainstream and set up, potentially a crypto reserve in the United States. And that was greeted by many in the crypto industry as really good news. But then some of these schemes, took place, erupted, and that didn't go down well in some corners of the crypto market, as you can understand, because it shows that there is real Wild West tendencies still in the crypto world, and these pump and dump schemes. You've had them on stock markets as well, when in social media forums, certain coins are really hyped. Look at Dogecoin, for example. Elon Musk, he said Doge is going to the moon. He said Doge is going to the moon, and it's just a lot of hype and speculation, and then it came back down to earth again. So you just got to be really careful and think, where's the institutional money going in? Think, read up. Think, where are the big banks? Where are the big institutions? Where are the big US institutions? Where are they putting their money into? Yeah. And they are starting to put their money into Bitcoin and some into Ethereum and Solana and things like that. So there are, in the Wild West, there are some stars that will shine more brightly than others. Yeah.
The one thing I do want people that are watching and listening to this is definitely to be careful and not let that, greed take over you and try to put all of your money into it, because it's very similar to the stock market. When people approach these investing, it's always with the mindset of 100%. And I think the rule of thumb really for anything, right, something like this, especially crypto, really, people say maybe up to 5% of your total portfolio. Obviously, if you're very one of those really risky people, some people might say, okay, up to 10%, but you really shouldn't be looking at doing 100%. Absolutely not. You should only be investing in crypto with money that you can afford to lose. Yeah, exactly. Because the problem is, again, you never know when to jump in, when is the best time to jump in. And people get really drawn to it when it's already jumped a significant amount. And of course, if you jump in at that point, there is certainly no guarantee that it's going to, climb again to that extent. And if you need your money before that time that it climbs again and it suddenly falls because it's super volatile, you'll be really unstuck. However, crypto is going to stay as part, I think, of the financial system. So if you can afford to lose the money, it might be worth putting a little bit in. But just be very wary. And I would say that it is still speculation territory rather than investing territory, at least with companies. And there can be speculation on financial markets and in equity markets. But often you can know exactly what that company does. You can look and say, it creates that product. The thing is, what does crypto create? Some people have the arguments on projects and stuff like that.
Ethereum is the basis for many apps and smart contracts. Bitcoin is becoming a store of value, or wants to be. Well, it's like it's a person, but you know what I mean. But all the other coins and tokens out in the Wild West.
Yeah, it's got to be. It's an area you got to be careful. As I said, people don't let the greed take over you, and look at this space as somewhere like you try to do a quick win, because it's likely you're going to get burnt. That's the truth, right? And I know some people might be thinking, no, it's likely you're going to be burnt. Trust me, I've been in crypto for a while, and
Have you been burnt?
Yeah, I've been burnt, but I've made more than I've done because I've held. But I've been burnt by like little ones, like little ones that are not proven. Where you're like, okay,
ones.
Yeah, where you're like, okay, let me try and see, false promises. But I haven't put like a lot. It's not like life savings. It's like, okay, let me test 100 here, 200 here, and see what it's like. And I think that's how people should approach it. People shouldn't be approaching, okay, I'm going to put my whole life savings into that.
Going to watch the races and putting money on some horses. Yeah. That's what it's like. Yeah, loads of people do that. We don't criticise it. It's the day out.
Yeah.
Fine. So approach it like that, and then you'll be all right.
Yeah. Thank you so much, Susannah. This has been a great conversation. I've learned a lot from you today, and I'm sure that the watchers and listeners really appreciate this as well. Thanks so much for sharing your stories as well, early life and the values that you came up with into getting into, into your career, and also about the markets as well. Hopefully in the future, I'm hoping that, the world becomes a bit more cohesive and people start working together again as bit more peaceful. I hope we can get to a world like that, because we're in the modern world, so you would expect that we can try to come to a common ground on things. We're not going to always agree on things, but let's try to come to a common ground. I think that's important. Where can people connect with you if they?
I'm at Susannah Shares on Instagram and at Streeter News on X, and just find me on LinkedIn.
Amazing.
And I have got a few projects going on at the moment that I'm hoping to launch my own podcast and video series to really boost financial resilience and do much more explainers about financial markets, how to get into investing, also perhaps how to become entrepreneurs as well. So watch this space.
Yeah, I think that's important, especially in this day and age where people are like, we've got this cost of living, inflation. I think this education is important to just really help people, because when this does reverse, then they're better positioned to help themselves and, to have the lives that they want to have for themselves as well. Do you have any final words for watchers and listeners?
Yeah, don't be put off by huge volatility that we're seeing, geopolitically and on financial markets. We have seen this before at certain times in history. You've just got to be in it for the longer game. Sort out your level of risk, but also inform yourselves, listen to podcasts, read the analysis, and just spread your risk, spread out your investments around the world, and just keep your eye on long-term horizons.
Thank you so much, Susannah. I really appreciate featuring on the podcast. Thanks so much for tuning into this week's episode. See you next week's episode. If you enjoyed this episode, share your favorite part in the comments, tap the like button, and subscribe to the channel. Your support is really appreciated. We'll keep working hard to bring you more valuable conversations.